Bitcoin is an exploding asset class. It's really it's the greatest treasury reserve asset of our lifetimes, and it's the solution to every company's treasury problem. So if you have a corporation that has capital or generates cash flow, you can immediately double or improve the value of the company or dramatically enhance the value of the company simply by changing your treasury policy.
So
if you take a company with cash and you invest in Bitcoin, you have converted a liability to an asset. And so I was enhancing the value of the company by pursuing the Bitcoin strategy. They go together. They're synergistic.
So let's lay out the kind of the context for people who don't know exactly how it all played out. Because I would say in our audience, right, we're going to get about 300, 400,000 listeners this month. And in that audience, probably, 5% are as crazy about Bitcoin as me, and have put a huge chunk of their net worth into Bitcoin. And then, 50% are curious and 50% are novices, let's say, just roughly rounding things out. And so just to put it into context, MicroStrategy is this couple $1 billion public company. It's been around for a while, has a good track record, has a business selling enterprise software. You generate a ton of cash. Your business spits off cash. You have about 500, 600 million. I'm just using fuzzy numbers. Specifics don't matter. You use about 500, 600 million dollars of cash. That's your treasury for your company. And you're looking for something to do with it. And at some point you realize you have this treasury problem. And you're not alone. Actually, all companies have this treasury problem, whether they are aware of it or not. So can you describe the treasury problem that you experienced? And you experienced it at a $500 million level, but anybody, including an individual with $500,000 or $100,000 in the bank, has the same fundamental problem. So explain the treasury problem as you saw it a few years ago, or about a year ago.
The treasury problem is that subsequent to March 2020, the cost of capital exploded from 8% to 25%. And you can see that in the performance of the S&P 500 index, which went from about 8% a year for a decade to more than 25% in that next year. That means that anybody investing money on behalf of a limited partner or any other investor has to generate that cost of capital in order to avoid destroying wealth. If you generated less than a 8% yield for the decade from 2010 to 2020 as a financial advisor, you destroyed wealth because the alternative was just to buy the SPY index. If you generated less than 25% from March of 2020 onward, you destroyed wealth because you could have made 25%, actually a bit more, depending on what day of the week you measure it or what day of the year you measure it. You could have generated that much just by owning the index. Now, the treasury problem is that when the cost of capital is zero, by the way, the cost of capital is being driven by the expansion of the money supply. The Federal Reserve is expanding the M2 money supply by about 5 to 6% a year for that decade. And when you tack on the risk premium, you get to your 8% S&P return. When the Federal Reserve expands the M2 money supply by 20 to 25%, that's where you get that explosion in the cost of capital. The inflation doesn't show up in consumer goods. The inflation immediately shows up in assets. We have asset inflation. Within minutes of when the central bank decides to stimulate the economy, the price of all the assets explodes. And so the problem for every company, all 100 million companies in the world, every private company, every public company, the problem is you have capital in your treasury, and that capital has to yield the cost of capital. And if it doesn't, you're destroying shareholder value. Another way to say it is, if you generate cash and you put it into the bank account to pay zero interest, and if the cost of everything you want to buy goes up by 10% a year, in 7 years, you only be able to buy half as much. You've lost half of the value of your savings. When that discount rate or that cost of capital doubles, well, then in 3.5 years, you've lost half your money. At a 25% cost of capital, In 3 years, you've lost half your wealth. So the treasury problem is the cost of capital has exploded. And the cost of capital, as it goes through the roof, puts every company in a quandary. They either have to decapitalize and give all of their assets back to their shareholders because they can't. If Sam is controlling an investment company that invests in dollars, and you are running an investment company that invests in the S&P 5 index, and I gave each of you $1 million, and Sam proudly tells me how he didn't lose my money, and you tell me you made 25% return, I'm pulling all my money out of Sam's fund, and I'm putting it into your fund. So ultimately, the problem is the company sitting on capital. If it can't meet the cost of capital, it has to give the money back to the shareholders, or at least it's under extreme political pressure from the share. Everybody's beating you up as CEO saying, what are you doing with all that cash? You should just pay a dividend or you should buy the stock back. And the second pressure you have is if you run a company and your cash flows are growing at 8% a year, but the cost of capital is 25% a year, that means that I'm discounting you at a rate that's higher than your growth rate. In essence, the value of your stock is going to be forecast to go to zero. You can't hold value in a company growing at 5% a year when the cost of capital is 25% a year. That's why the only thing you can buy is going to be a high-tech stock that's growing. You need to buy a tech monopoly that can grow 20 or 25% a year. And if you come to me with a business idea for a company which makes a lot of cash or makes a lot of money, but is growing 2% a year or 1% a year, I'm just not interested in a high cost of capital environment. So the problem we faced in March is, what do we do? Give all the money back to the shareholders? Or can we find something to invest in that's going to actually generate more than 25% return? And that puts us to a question. So what we did, in essence, was split the difference. If I was in a situation, in the ideal situation, you would just buy 500 million worth of Bitcoin and put out a press release and do it. But if you did that, that would be such a shock to the outside shareholders that the fear would be, well, is someone going to sue us or dump the stock because you were so aggressive, because they'll claim that you took a risk that you didn't disclose. So our response is, let's disclose, everybody, we're about to take a risk. And after that, let's go ahead and take a risk, but at the same time, let's give everybody an insurance policy. So we offered to buy back $250 million worth of the stock in this Dutch auction. So if you disagree with the decision to buy Bitcoin, you can sell the stock back at a profit. Our stock was 120. We offered to buy the stock back at up to 140. And so we cushioned the blow of the investment strategy by giving people an exit strategy from the equity. Right. That rotates the shareholder base, and then we began to pursue the Bitcoin strategy as a primary treasury reserve asset with a different shareholder base.
So let me ask you a question. Now, I like the analogy or the kind of the awareness that, hey, we have this giant bowl of ice cream that's melting. That's your cash pile that's melting, and the heat is basically the money printer that is causing asset inflation.
An ice cube that's melting.
We have
a $500 million ice cube, and it's melting 20% a year. Right. And it'll be gone in 5 years.
So you needed to do something with that. You didn't want it to all melt away. So you decided to do this. Now, a couple of quick questions. One is, this is sort of rapid fire. I've got a couple of rapid fire questions for you. Yeah. In 20 years from now, what do you think has generated more value or more income to the company, to MicroStrategy? Is it the operating income of MicroStrategy or the investment income of the Bitcoin it holds?
The investment income for sure.
Okay. And then,
to be very clear, what happened in March of 2020 is when the cost of capital goes to 25%, that means that every investor and all investment income, every investor generated 25% more doing nothing.
Right.
And every Main Street company that worked 25% harder got nothing. Right. You literally tilt the playing field so that if you own assets, you're having the best year of 30 years. And if you don't own assets, it's impossible to have a good year.